So we follow the price, we trade with the price charts, even though I'm very bearish. I think there's going to be a huge reset in the markets. I think we could see a 30 to 50% decline from where we are in the US stock market. And it's going to hurt real estate. It's going to hurt precious metals. The dollar could rally fairly substantial during that short period of time. So there's a lot going on.
On this episode of What the Finance podcast, I have the pleasure of speaking with Chris Vermeulen, who's founder and chief market strategist at Technical Traders. So, Chris, thanks so much for coming on the podcast today.
Hey, thanks for having me, Anthony. A pleasure.
No problem. And I'm really looking forward to our conversation because I guess if you ask anyone what was happening at the end of 2022 and 2023, they're probably going to say, oh, further downside, more bearishness. That's what we're going to see. But it hasn't really turned out like that way. You know, if you look at the year, it's been a very bullish year. And I think a lot of traders have sort of been caught off guard. So what's your opinion on that? Were you expecting this type of movement? And I guess, what are you expecting in the next 6 months?
Yeah, for sure. I think people coming into 2023, you look at the COT data, like where the institutions and individuals are putting their money, they are all betting on a downside move. They thought 2023 was going to be a bloodbath, a continuation from the previous year, and we got the exact opposite. And that's what the markets love to do. I mean, they pretty much try and get everybody to go in one direction, and then it goes the opposite. So, I mean, I follow the markets from a very different perspective than a lot of others. I haven't watched or read or listened to the news in over 10 years already. I'm a pure technical analyst, which means I follow price. So I don't care what the news is or what the interest rates are doing or the Fed says. If a trend is going up, we want to be long that asset. If it's going down, we want to make sure we're out of it or benefiting from falling pricing. But overall, the markets, you can't predict what they're going to do. So the best thing you could do is follow them and have a really good strategy that gets you in when there's a decent trend in play. And then you have to manage those positions going forward. So, I don't usually put out big projections of where the markets are going. I have some ideas and I'll share my opinions where I think they could be going. But overall, it's all about following price. And as we kind of talk, I think you'll see here, I'm pretty bearish on the markets. My opinion is bearish, but we're actually long the markets still. So people have to be able to divide between opinion and following price, the reality of price action.
Yeah, it's really interesting to hear that because, as you said, it's sort of quite counterintuitive. You're bearish, but then you're long. Most people wouldn't think like that. But can you maybe go a bit more over your investment strategy? You mentioned that you're sort of technical only. You're looking at these trends. So what would be, I guess, the key confirmations you'd be looking for to put a position on, and then time frames, and if whatever you can share, that'd be great.
Yeah, so I think the best way to kind of show people kind of the way that I see the markets is through this infographic that I created. And it's broken down into a few sections. And if I cut through these and we go through that, the market moves in 4 stages. So the key here is we want to follow price. We don't want to pick a top when we think it's topping out. We don't want to try and pick a bottom. We just want to follow the trends. And I like to look at the stock market and assets like the tide is going up and down in the ocean. If the tide's going up, we want to make sure we're naturally going to be only focusing on strategies that profit from rising prices. The market's going down, we want to take advantage of falling prices. And even when the tide's going up and down, think of surfers floating out on the horizon. They're waiting for a set of waves. This is what I do. I sit back. I know what the underlying trend is. So for example, we could be in a bull market phase. Doesn't mean we're just long the markets. We actually wait for an asset to come along that has a perfect setup, has a high probability opportunity to have another rally, which is like a wave in the market. We're waiting for a perfect set in the market. So looking at this strategy here, we have 4 stages. The stage 1 is a basing strategy. I have this shaded red because a stage 1 period is a choppy market. You don't know if it's bottomed. Sectors are all over the place. It's kind of dead money. You're better to go find an asset that is in a stage 2 or a stage 4 for 2 reasons, or for one main reason really, is there's a strong trend in play. Either price is rallying or it's selling off in a big way. When something's trending, we can make a lot of money. A stage 3, which is where the markets have been really since, you could argue, 2022 and 2023, they're stuck in this stage 3 pattern. It's a tough, difficult time. We've got sectors all over the place. 1 month, one group of sectors are leading the way. The next month, they're at the bottom of our hot list that I follow. And it's a very difficult time, which is why it's also shaded in red. So as long as you know what stage we're in, you know a basic strategy that you need to be deploying for that type of market condition. And then the market is also broken down into the emotional aspect. And the stock market is all just people's emotions. They're either bullish or bearish. They're buying something or they're selling it. And if you understand the emotional cycle that people go through, that is a huge chunk of the strategy of the game, is knowing where the market is. And if we were to, in 2023, we're in this complacency move where the market has been moving up after we had a big 2022 sell-off. And people are getting really bullish. People are piling back into growth stocks, into AI, into technology. They're getting really bullish. And that's what the market loves to do. Try to get everybody long before it potentially goes to a big swan dive, a stage 4 decline. And stage 4 declines are very rare. The last one was the 2008 financial crisis. The one before that was the tech bubble burst. So, these are big, devastating moves, usually wiping out 50+% of your portfolio in a short period of time. This is what ruins people's retirements, relationships, marriages. I mean, these are really devastating periods that we could be going into. And the nice thing of being a technical trader is we get to ride this kind of bullish side of the emotional aspect twice. For example, when we start off in a new bull market, we're optimistic, we're benefiting from it. It's a thrill, it's a euphoric phase when we're making money hand over fist because we're playing the trend. And then we go into a stage 3. And while most people are going into anxiety and denial and panic, and they're watching their account values fall, we're actually riding it down. Like anxiety would be kind of like the optimism and belief. We're like, oh my gosh, we are in a stage 4. This is amazing, huge opportunity. Stocks fall 4 to 7 times faster than they rise. So we can make more money in a bear market in a fraction of period of time than riding a 5 or 10 year bull market. So we get to ride this, this anxiety, this fun phase to the downside and become wealthier as the world's kind of falling apart. So that's kind of the mental aspect of the game. And then we can take it one step further and actually look at the different cycles that the market moves. And we've got this blue cycle, which is the stock market cycle. And it shows what different sectors do during these stages. And then we got the yellow cycle, which is the economic cycle. And the stock market will always top out before the economy, and it'll also bottom out before the economy does. And that's because investors are smart. They can see company earnings slowing near a market top. They start to sell shares. They start to rotate to a different asset. And so the stock market starts to go down. And then, eventually we get bad economic data for 2 quarters in a row. And then finally, everybody comes out saying, oh, we're in a recession now, official recession. Yet the stock market has already been under pressure for months, if not a year already. And then, the big stage 4 decline really takes place because now the masses start to dump their shares. And the interesting aspect is in 2022, we saw energy stocks do exceptionally well. They have then since topped out. Precious metals were the market leader early in 2023. And, so these last 2 sectors are kind of the last 2 before the stock market goes into this big move. And we've seen this happen during the last 2, just before the last 2 stage 4 declines in the 2000 and 2007 market top. So that's, really high level. I know I covered a lot there really quickly, but that's a high level technical view of kind of how the markets rotate. Money goes through these phases and stages and how people react to them. And that's more or less how I kind of rotate my money through the markets. And I have a strategy which I call asset revesting, which is, we'll talk about that in a bit, but it's a very different strategy than, the buy and hold strategy and what active traders are doing. So that's kind of how I view the markets from a very high level to get an understanding of where we are, what strategy needs to be implemented.
Yeah, it's a really interesting way to look at it. And as you said, it's different to what others people do. So even though you mentioned here that there's sort of the economic cycles, the stock market cycles, the key thing that you're looking at is price. So you're not fussed about anything else that's happening outside of the charts. You're just looking at price.
Exactly. Yeah. As investors, the only way we make money is if the asset we bought goes in the favor that we want. And, when I started trading, this was like, over 25 years ago, all you have to do is own really strong stocks that have earnings quarter after quarter, and then, the stock price gets cut in half because you're in a bear market. And you're like, well, even if I have a good company with good fundamentals, I'm still going to lose my shirt. And so that's when, I threw fundamental data out the window. I threw news out the window. I'm like, if it's going down, I don't want to own it. If it's going up, I want to own it. And I really just came down to something that simple. How do I identify when something is in a strong uptrend that should have legs behind it, meaning it can run for weeks or months, versus getting chopped up in the daily noise of, oh, it's, big up day here, big down day here. People usually zoom in a little bit too close to the charts and they get a lot of noise and they don't know if it's in a strong uptrend or not. I bring a lot of analysis, intermarket analysis, I call it, because almost every asset is linked behind the scenes in some way between gold and interest rates and bonds and stocks and different currencies. So if you know where money's flowing between all these different assets, some of them are risky, like a risk on asset. Some of them are defensive. And so once you can get a gauge what the big money is doing, where they're dumping their money, you can kind of ride their coattails, know that there's a lot of power behind it. Because when institutions start moving all into the same direction, they create trends that last months and months. And so you want to make sure you identify those trends, get positioned, ride those trades, and then manage your risks, scaling profits out and things like that.
So how do you identify these strong trends without giving away too many secrets?
Yeah. So long story short, I mean, we use a lot of different proprietary analysis and tools for it, but a really basic way is to use just some simple moving averages. Typically you want, the 50-day moving average sloping up. You want price above that moving average. You usually want the 20-day moving average sloping up. You want the stock market to be outperforming utilities. Utilities are known as a defensive play. No matter how bad the economy gets, people still need running water. They need electricity. So you want the stock market to be outperforming the really boring assets. Consumer staples are another one. Who wants to buy toilet paper and toothpaste? So, if the stock market can't beat those boring sectors, money is moving into these defensive sectors. And you should be very wary and protect your positions because a sell-off may be coming. And we saw this just before COVID. We saw utility stocks take off and outperform the stock market dramatically just a few weeks before the COVID hit and everything crashed. And we've seen this time and time again in history. Utilities will do very well. And that's actually a warning sign. That means money's moving into these defensive plays because they want to get out of the fast moving growth and tech stocks.
Yeah, it's great points. And as you said, you have to almost zoom out. So I'm assuming that you're not looking, especially for these bigger movements, you're not looking at sort of the lower time frames. You're looking at the higher time frames, like daily, weeklies, monthlies.
Yeah, we do. So a quick example here would be there's two charts of the SP 500 here. The top one is our weekly kind of investing signal chart. So it tells you when the tide is going up. It tells us when the tide is going down. And right now, we're currently back kind of in a rising tide mode. So this tells us, what the oceans are doing, the markets are doing, going up or down. And then below it is our shorter term strategy, kind of our more active investing strategy where we can catch these plays, avoid market noise, catch a play. There's a little kind of a reset here, another play. So we want to make sure we look at the longer term chart. Is the tide going down? Is the market going to struggle? You can see here how the market struggles when the long-term trend or the tide is going down. And then once you get back into a bullish phase, you get these extended trends. So it's very important to understand the longer term view and the shorter term views. And then of course we go much more granular into 30-minute data and money flows between different assets and commodities and things like that. But from a high level, if you know what the direction the markets are going, then you can deploy strategies to take advantage of rising prices. And then when the market's weak, we can move into different assets. Like during 2022, when the market sold off, the US dollar index was one of the strongest plays. So whenever we get a sell signal, you can move into the US dollar ETF. And the nice thing about currencies is they move really slow, but they trend really nicely. So you can step away from the markets and the risk and then move into a currency and continue building your wealth while the market's kind of falling apart. So that's kind of how I view the market, as you said, with the different time frames.
And is that connected to your sort of reinvesting strategy?
It is, yeah, yeah. All this is kind of interwoven into the strategy.
And how would you define that? Is that exactly what you were saying there? Sort of like transitioning between all these different assets, depending on, interrelated data that you're getting from the flow of money?
Right. So yeah, so the asset revesting strategy, the way it works is we hold one asset at a time. So we'll create a hierarchy saying, okay, US stocks, the US indexes are the best opportunity. There's a lot of volatility, a ton of volume, so we can move money in and out easily. If the stock market is not favorable, then we want to go to a different asset. And we work our way down this asset hierarchy to potentially bonds, the US dollar, bill, which is just a dividend paying 1 to 3 month treasury note ETF. So as the markets get crazier, we move down the list to a different asset that's uncorrelated, not correlated to the stock pricing. And they also have lower volatility. So we do the opposite of what most people do. When the markets go wild, usually people like ramp up leverage and they actively trade and they trade leveraged ETFs. We do the exact opposite. When things get crazy, we step back and move to slower and slower assets and things that move more consistent and have a lot less risk. And we want to grow our entire portfolio. So the whole thing with the asset revesting strategy is something that you can put your whole portfolio to work with. And you only have one position on at a time. You're only in the one asset class that is performing best. Could be stocks, bonds, the dollar, could just be literally just a cash in your account when things are really crazy. But that's what asset revesting is. Instead of investing and just buying something and holding onto it forever and going through that roller coaster ride, asset revesting is taking control of your assets and reinvesting it into the best asset at any given time, and being out of the market when nothing is really favorable.
And is that based on the sort of the price action of those assets as well, or is it based on, you mentioned the other data points as well? So I'm guessing there's all these different prices and factors that go into it.
Yeah, there's a lot of different factors, and they kind of help color code the chart. I've kept it really simple: red, green. It's as basic as it can go, with signals on it. But yeah, we take into account all the different assets that are moving, and we just kind of rotate through the hierarchy of those positions. And yeah, that's kind of just the whole key, is to not hold something going down. I don't believe in, if something's going down, there's no point in holding it. Which it bucks the trend from what typical investors do with the buy and hold strategy. But right now I'm really trying to help as many people as possible, because there's more investors now than ever, and the majority of them have a substantial amount of wealth. They're typically in their later years. They're close to retirement, already retired. And if we go into a stage 4 decline, it's going to create the most maximum pain to the most amount of investors in the world. And the last thing you want to do is delay your retirement or have to downgrade your living style, your lifestyle, all those things. So Murphy's Law is, the worst thing's going to happen at the worst possible time. And to me, a big stage 4, stage decline with a big reset, maybe even a currency, the US dollar could get killed over the next few years. It's the worst thing that could happen to, investors who are invested in the markets.
Yeah, I think we saw this in the 2008. That sort of happened to quite a lot of people, and they had to get back into work and actually, continue work, even though they thought they could retire because of the destruction of their wealth. You've mentioned that it looks like, especially now we're in stage 3, it's a little bit frothy, bullish at the moment, but obviously that could change and go into stage 4. Why is it that we haven't experienced stage 4? Because if you look at, I guess, what happened during 2022, we had quite a big drawdown, NASDAQ close to 40% drawdown. That seems like that's quite a large movement. So why don't you think that was the stage 4?
I don't think it is, just because to me, prices haven't reset. Real estate are still frothy. Everything is double, triple the price it was from not that long ago. PE ratios are still super high. We just haven't seen a reset. Really, we need to see everything crash and have a financial reset. Really, all we're doing is drifting back up. People have false belief that we're going higher. Now, mind you, I could be totally wrong, and these markets could continue to rally, and there's nothing wrong with that. And this is where my view, what I mentioned right at the beginning, people need to understand we're long the markets right now. We're riding this trend up. But when you step back and look at the big picture, it looks like a stage 4 is coming. No matter what the markets do, being a technical trader who manages positions, if the markets keep going up, we ride this higher, and it could go on for years. If it rolls over, we exit our position, we find something to benefit from falling prices, and we go to the downside. And that's where, what I do really deviates. I don't let my opinion get in the way. So we follow the price, we trade with the price charts, even though I'm very bearish. I think there's going to be a huge reset in the markets. I think we could see a 30 to 50% decline from where we are in the US stock market. And it's going to hurt real estate. It's going to hurt precious metals. The dollar could rally fairly substantial during that short period of time. So there's a lot going on, but we are still in an uptrend, and we got to ride this and wait for it to, confirm a downtrend before we change our game plan.
And I know you've mentioned some indicators, and it's probably me asking a similar questions again. How do you know when we've hit that stage 4? Is it just that, as you said, there's just the absolute desperation? There's these massive drawdown. There's all these other factors.
There's a pretty good way to kind of gauge it. If I go back to this chart, there's this dotted line, this moving average on the chart. And so this stage 4 analysis I actually took from Stan Weinstein's book, How to Profit from Bull and Bear Markets. And he breaks the markets down into these 4 stages. And he uses the 150-day moving average, which is this dotted line. And more or less, the general rule is if the moving average is sloping up and prices consistently above it, you're probably in a stage 2 advancing stage. If it's starting to flatline or head down and prices chopping through it, you could be in a stage 3 topping phase. And then, of course, if it's sloping down and prices consistently below it, you're in a stage 4 decline. And then the cycle kind of rinses and repeats. So we're in this phase here where the stock market is it's getting close to those all-time highs, and the stock market might actually push up and hit all-time highs one last time. And I kind of feel like the market is really going to be gunning for that, because people right now are piling back into the same stocks that just sold off like 60 to 75%, which are like the ARK ETFs, all those crazy growth and tech small cap companies. If we get the stock markets to just even one tick to an all-time high, it doesn't matter what index it is, it's going to be headline news that stock market's hitting all-time highs. That will be like the nail in the coffin for the average investor to put the rest of their capital to work, to pile in, feel like they're missing out. They'll all have FOMO and they want to ride the next 5 or 10 year bull market. But the market will probably jump on and sell into that news right after it's sucked everybody in. We've seen this happen time and time again. So this market still might continue to go up and hit those all-time highs and get everybody to finally give in before the market reverses and changes. But this moving average is a good gauge. Right now, price is above the 150-day. It's trending higher, and we're going up for a potential double top on the overall stock market.
And which time frame is that on, sorry?
The 150-day moving average is based off the daily chart. So you use the daily chart for that gauge.
Okay, makes sense. So then I guess if we were to see maybe if it were to increase and sort of go back up, or is it already sort of going up?
Yeah, the 150-day is sloping up. It's going back up and price is above it. But we're coming into a pretty significant topping phase, on this chart. A basic analysis is a double top pattern. If we were to just look at the SP 500 here, the SP 500 is right up into a resistance area. If we were to, draw a level from where it topped out a couple of weeks ago, you can see it's at a very significant previous high. It's struggling with the 2021 highs, and it might just want to, rally up and peak and break the high from 2021 or 2022, and then, could start to sell off in a very big way. And the NASDAQ is the same. You look at the NASDAQ chart, it's rallied up equally, or percentage-wise even more, and it's going up for what could be a huge standout double top as well. Again, this is all just opinions. What looks like is unfolding. We remain long this market because maybe it's going to break out and keep going, but when you step back, you do need to be very aware that this market is doing a perfect job. It's unfolding through all the cycles we've seen. Everybody's just starting to get really bullish again. And that's what the market does. It has to get everybody long before it rolls over and sells off and sells and starts a new downtrend. It has to try and get the majority of people on the wrong side.
Yeah, it makes sense. And you mentioned the hierarchy. So what would the hierarchy be, I guess, or at least maybe a few? So you've mentioned, I'm guessing NASDAQ and those really high beta stocks be at the top, or, Bitcoin and then maybe NASDAQ and then maybe other less high beta stocks and then utilities. And I guess you said other commodities. Can you maybe go through a few of those?
Sure. So yeah, I keep the hierarchy really simple. Now, anyone can build their own asset revesting strategy using all the assets that they prefer. I want to keep things as simple as possible. I like ETFs. I don't want to get into individual stocks. I want to be able to move large amounts of money into an asset and move it out with, quick order, click of a button, we're in or out. So the way my hierarchy works is I look at the indexes, US indexes at the top. That's the best opportunity. If they're favorable, it's going to give you the best percentage return without having to go into more risky stuff like individual sectors or stocks. And then it goes into US Treasury ETFs like TLT, the long year Treasury note. And then from there, we go to the US dollar index, and there's a long and an inverse. So it doesn't matter if the dollar is rallying or falling, we can move into that and still take advantage of the currency when bonds and stocks are out of favor. And we saw that in 2022. Stocks and bonds were out of favor. And most people were like, what the heck is going on? How are both falling? But, we saw this, unfolding a long time ago. We haven't touched bonds. We got out of bonds the day they peaked, actually, because it blew past our targets in 2020. But overall, so it goes stocks, bonds, currency, and then just a cash position. So either you sit in cash and wait for a fresh trade, or you move into BIL, which is literally a 1 to 3 month treasury note ETF, and it just pays you a dividend every month. So you can still generate a few percent, just waiting safely, preserving your capital, preserving your lifestyle until there's a new opportunity. And that's kind of where we're at now, is we're looking at moving into that type of position when this market changes trends, if there isn't a different asset to get in, because bonds are still moving down. So stocks and bonds won't be in favor likely at the same time.
Yes, that'll be different to what we saw in 2021, 2022.
Yeah.
Yeah, no, perfect. It's really interesting to see. So, Chris, thanks so much for your time today. I really appreciate it. I guess my last question is, what is one message you'd like people to take away from our conversation?
I think the last message is, I mean, depending on what type of trader or investor you are. So the strategy that I use, our trades last 1 to 8 months. You need to figure out, if you're happy with the style of trading that you're doing. People are either with an advisor with the buy and hold, and they could go through a much more devastating scenario. And is that something they want to go through? If you're a really active trader on the other aspect of the whole other area of the range there, being really active, statistically, there's been all kinds of studies that show it's about 95% of active traders lose money, even during a bull market. So the more you trade, the more likely you are to lose money or just to churn your account. You never really grow it. The strategy that I use is right in the middle. For a passive investor, it seems a little active. We got 5 to 12 trades a year. For an active trader, mine seems way too slow. And that's probably one of the reasons why it works so well, is simply because it's using big waves in the market, big cycles, and we're riding kind of, a really kind of, to most people, it's an awkward time frame that we're in these. And so people just need to understand, like, do you want to be active? Do you want to be passive and ride the roller coaster? Or do you want to just use something that follows price and then manages those positions, which is what I do. So I think the key is just people understanding there's big risk around the corner potentially. Make sure you avoid it. Even if you do nothing, like literally move to cash and let a bear market happen, that is better than riding it down. So.
Yeah, makes sense. So thanks so much for your time today. I really appreciate it. So if anyone wanted to find more about your work, I guess the technicaltraders.com is that the best place. Is there anywhere else?
Yeah, they can go there and find out everything that I do and follow me my free blog.
Perfect. I'll put that all in the description below, but thanks again for your time.
Thanks, Anthony. Take care.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.